Special orders, past costs or sunk costs, and relevant costs. And the key to this discussion is that when you're making a decision about pricing a product, as odd as it sounds, not all of your costs should be considered in that pricing decision. In other words, not all of your costs are relevant. So I'm going to give 3 examples. The first is, let's say you're an airline. There's tickets priced at $400. The plane has 1 open seat and leaves in 5 minutes. And the question is, how can you price that ticket? How low can you price it and still make a profit? Well, the thing to keep in mind is that all the fixed costs are already paid for. And in addition, almost all the other variable costs are paid for. So salaries, fuel, maintenance, gate fees, insurance, benefits to everybody who's running the flight. All that's been paid for. So the question is, what costs do you need to cover with the price that you charge on the ticket for the last seat that's left on the plane? And really, the only costs are drink and a snack for the person who's on the plane and the cost to track the ticket, process the luggage, etc. So you may be able to price the product as low as the ticket, as low as $100 or even less, and it's still profitable to sell that ticket because so many of the costs are not relevant because they're already paid. That's the airline example. Second example is a special order. This has to do with an order received close to month end. And the issue here is that because it's close to month end, most of your costs for the month have already been paid for. You've already paid the lease. You've already paid maintenance on machinery. You've already incurred most of the costs that you would incur to run your business. So again, pricing decision, what costs are left when you're pricing a product? So let's say it's a sporting goods company that sells a baseball glove for $110. The only costs that are relevant are the variable cost, labor and materials and packaging to actually make the glove. Everything else has been paid for. Again, you may be able to price the product at far below $110 and still be profitable because so many of the fixed costs and other costs have already been paid, meaning they're sunk costs, they're not relevant. The third one is, and this is something that's unusual on its face, which is closing a retail location. Let's say you have a retail shop that does $300,000 in revenue and $320,000 in expenses. It operates $20,000 loss. But you have a $30,000 annual lease that you have to pay for. In that case, it may make sense to continue operating, get the revenue in the door, and lose $20,000 because if you close the facility, you don't get any revenue and you still have to pay the $30,000 lease. So another pricing decision that is based on which costs continue and which costs aren't relevant.